You have got to be, you're smiling because A, it's warm, but B, you're a big Facebook owner. Facebook is soaring. What do you think of the quarter, and are you adding to your Facebook position?
No, we're not adding right now. We added in the 140s twice, actually once a year ago when Mark Zuckerberg was getting raked over the coals in front of Congress, and then again recently when the stock was, again, suffering from a gloomy consensus, let's call it, and trading around 14 to 15 times earnings. This is the worst quarter Facebook has had in terms of revenue growth, up 30%. And, 2.2 billion users. It's hard to find fault with the economics of the business.
Except that how much bigger can it get? How much growth is there?
Well, there's not a lot of growth per se, and certainly in users. I think there's still monetization of the users and monetization of Instagram and things like that. So, again, the company with that kind of global scope has an enormous moat around it, and I think it's going to be very tough. And with the new money they're spending on security, and it's going to be very tough for anybody to push them aside.
Going into the commercial break, David Faber showed a chart of the best stocks this month. Xerox up 43% this month. GE up 38% this month. Okay, after the worst December since 1928. What do you make of these insane market and stock swings? Collapsing, then is that a healthy market?
It's a market that can be exploited. I think you can monetize the volatility in the market, which is what we try and do. There have been 23 corrections of 5% or more in the last 10 years, so 2 per year. And corrections go deep enough to scare everybody out, and also then the market, market structure has been changed, in my opinion, by the combination of money in ETFs, trend-following quant funds, and risk parity products. And so they tend to all move together.
Are they harmful?
They potentially are harmful. Like the late Jack Bogle, who a friend of mine, said that the ETF thing and the passive money is a potential threat. I don't think it is now, but it could be down the road.
We talk a lot with you about Amazon and Facebook. I want to ask you about a totally different name, because we're so concerned that housing is, I don't want to say collapsing, but it's slowing down. One of your biggest positions is RH, Restoration Hardware. $4,000 sofas bill. What makes it attractive?
Well, part of why it's attractive now is that they've kind of taken over the high end of that market with their 40,000 square foot stores. And so it's a company that we started buying in the 20s when Gary Friedman, the CEO, started buying a lot of stock. They bought back 50% of their shares last year in probably an average cost of around $40 to $45. So it's not as attractive at 130 as it was at 30. But it's still a dominant company. The average furniture store in America is about 7,000 square feet.
I'll wrap it up with this. What's the last most exciting new stock that you've added?
Avon.
Avon?
Avon was at a 70-year low.
AVP. Are we talking about the makeup company?
$1.95 or something like that. Yes. Brand new management, all up and down. A couple $100 million of free cash flow. The proper strategy now for the first time in years, if not decades. And we think it's a company that it could be a 10-bagger in the next 3 to 5 years.
Avon's a 10-bagger. A company that
could be. Coty offered $10 billion for the company, I think, in 2014 or 15. It's got an $800 million market cap right now.
This is a company, though, Bill. I don't think it's TV, fake news to say there's people who are worried about Avon's long-term sustainability as a company.
Well, that's pretty well reflected in the price of under $2, I think. But we think it's a very interesting risk reward on Avon, and I think that I won't say worst case, but I'd say it's going to be tough for you to lose money in the stock over the next few years, given how much it's down in the past couple of years alone. And
well, Avon's moving right now. The stock is up 14% on your comments. Is this a long-term hold? You're a value guy, you're a long-term guy, but even you would say if I go from X to Y and it's this kind of percentage move, I've got to rethink my position, no? How long would you hold an Avon?
We'd hold it as long as we think we can earn an excess rate of return by holding it.
And still right now?
Oh yeah, right. It's now just it was $2.50, I think, about 3 or 4 months ago. So it's kind of making a home here between the $1.75 and $2.25 level. If it breaks out above $3, I think that'll tell us that the strategies are working. I think we'll know that by the end of this year.
David Faber, I know you've talked a lot about Avon. What do you think of this move? The bankers have got to be happy or unhappy. I don't know.
By the way, we should tell Bill the stock's up 19% now. I think in part on Mr. Miller's comments right there. Of course, I can remember when they were turning down a bid from Coty that they absolutely, positively should have taken, without a doubt. But, Bill, I wanted to come back to you for a moment here on Amazon. I think we're going to be hearing after the close. Obviously, I remember you positive on the stock throughout, in the good and the bad, and particularly in some tough times where your opinion ended up, of course, being the correct one. What are you looking for after the bell? What should we be focused on overall in terms of both the earnings and on the conference call?
You know, it's an interesting situation. I tend to focus on the advertising business and on AWS, and then the mix shift where the third-party sellers are now more than 50% of retail. So that you're not seeing the sales growth in retail that you used to see, but you're seeing good margins. And I think also, you know, international is still losing money, and I think that in the next couple of years that will turn. But you know, Amazon is doing so many different things, and it's so dominant, and it's about 20% below its high. So I think it's very attractive in here.
Why is it very attractive in here?
Because I think that the business itself on the top line is probably going to grow around 20 to 25% a year for the next at least 3 years, and the margins should continue to expand. So if the valuation doesn't change, and I don't think the valuation should change, in terms of enterprise value to EBITDA, price to sales, that kind of thing, then the stock will double in 3 years, and the market's not going to double in 3 years.
Hey, Bill, it's Sarah. I wanted to ask about Apple. I don't think you own it in the fund, but I've heard you talk about it in the past and view it favorably. We just came off of an Apple quarter, which was well received by Wall Street, but also showed that iPhone sales are declining. Is that a good bet right now after the big sell-off that we saw from the last quarter?
Well, we had both bought and sold Apple well. I own Apple personally and have owned it for a long time. You know, if you want a company with a fortress balance sheet that's dominant, that is, I'd say, safe, that generates $50 billion of free cash flow, then Apple looks okay in here.
Bill, you know, guys, I want to jump back in because we talked about Avon, and you referenced, and David referenced it as well, that Coty, the consumer products cosmetics company, had made a $10 billion bid. Just off camera before we sat down, you told me that you've started adding to Coty. Is that a new position for you, or are you adding to an existing position?
That's a personal position of mine.
Personal position of yours?
Yeah, but I started buying it around $8.
Because that's a stock that's down 50% in a 12-month period. Is that a similar story to Avon?
Coty's pretty highly leveraged. JAB, the private equity firm,
that's buying everything,
controls it. But they bought every share that was available in blocks at around $8.50. The new CEO who just came in, he bought about $15 million worth of stock at $8.50, 7% yield on it. So again, I think that most of the damage has been done.